If tomorrow morning you wake up and see the news, a major war has just broken out, what do you think the first thing you would do is call your family, check whether everyone is safe, or immediately open your stock app to see how much money your portfolio is losing? It may sound strange, but in the era of digital finance, the most common reaction is not running outside or looking for shelter. The most common reaction is opening an investment app, not because the war is happening in your living room, but because financial fear often activates faster than almost any other instinct. This is exactly where most of the biggest mistakes in investing begin. Look at how financial crises usually unfold. When a major geopolitical event happens, a war, a military conflict, or a global shock, the market almost always reacts the same way. Stocks drop sharply in the first few hours. The news turns red. Headlines like "Market Panic," "Global Crisis," "Collapse" appear everywhere. And within just a few minutes, millions of retail investors around the world begin doing the same thing, selling. The problem is that reaction is rarely based on data. It is based on emotion. In behavioral economics, this phenomenon is called panic selling, selling in fear and chaos. When humans face major uncertainty, the brain tends to search for a sense of control. Pressing the sell button creates an illusion that you are acting intelligently, that you saw something before everyone else had time to react. But in reality, that action usually happens at the worst possible moment. A well-known study by JP Morgan shows this very clearly. If you invested $10,000 in the S&P 500 index and held it for 20 years, that investment could grow to around $70,000. But if during those 20 years you missed only 10 of the market's strongest days, the final value would be only about half. What is notable is that most of the market's strongest days actually occur right after its biggest declines. In other words, the moment when the market scares you the most is often also the moment it is about to recover the most strongly. This is why many investors believe they are acting rationally when they panic sell during a crisis. But in reality, they are doing the exact thing that makes their long-term returns disappear. To understand this more clearly, imagine two identical investors. Both have the same investment portfolio, the same amount of money, and both read the same news on the same morning. When the Russia-Ukraine conflict began in February 2022, the global market reacted immediately. The S&P 500 index dropped sharply when the market opened. The first investor looks at the screen and thinks, "This situation is very dangerous. I have to get out before everything gets worse." He sells his entire portfolio that morning. The second investor also sees the same news, but instead of selling, she turns off the news, goes to work as usual, and keeps her portfolio unchanged. What happens next is almost a classic lesson of the financial market. After falling sharply in the morning, the market begins to recover within the same day. Not because the war ended, but because the initial uncertainty had already been absorbed by the market. Once the event has occurred, large investors begin to reprice risk and capital flows back in. The first investor sold at the bottom of fear. The second investor did nothing. In finance, sometimes doing nothing is the hardest decision, and also the right one. There is another factor that causes this mistake to repeat again and again: financial media. Not because the media wants to harm investors, but because their business model is based on attention. Bad news attracts attention more strongly than good news. When the market falls 2%, the headline is usually not a mild cyclical correction. The headline will be, "The market plunges." When words like crisis or collapse appear continuously, our brain begins to evaluate risk as greater than it really is. This creates a dangerous loop. News makes investors afraid. Investors sell. The market becomes more volatile. Then, the news has even more reason to talk about crisis. Meanwhile, institutional investors, those who manage hundreds of billions of dollars, often act in the opposite direction. They understand that short-term volatility is a normal part of the market. Instead of panic selling, they begin searching for opportunities to buy quality assets at lower prices. This is exactly the difference between investing based on emotion and investing based on data. If we look back at more than a century of financial market history, we will see a very clear pattern. Every crisis creates an initial period of panic. But after that, the market almost always recovers, not because the world suddenly becomes perfect, but because the economy and businesses continue to operate. And this is the most important question every investor must ask when a crisis occurs. Do you want to become the person who sells assets in fear, or the person who understands how capital really flows? Part 1: The paradoxical truth. The market does not collapse because of war. If you ask most people a very simple question, is war good for the stock market? Almost everyone will immediately answer no. The logic sounds very clear. War creates instability. Instability makes businesses struggle. And when businesses struggle, the market must decline. But financial history shows a far more complex picture. In many cases, the market does not collapse because of war. In fact, there are periods when it even grows strongly. To understand why, we need to look at how the market actually works. The stock market does not react to what is happening in the present. It reacts to expectations about future cash flows. When a major event occurs, what matters is not the event itself, but how it changes the flow of money in the economy. Let us go back to history. When World War II began, many people believed that the United States economy would fall into a deep crisis. Yet what happened was completely the opposite. During the war period, industrial production increased sharply. The unemployment rate dropped significantly, and government spending rose to levels never seen before. Automobile factories switched to producing tanks. Technology companies of that time began producing radar, communication systems, and military equipment. As a result, a large part of the economy was activated by wartime demand. Throughout that period, the Dow Jones Index did not collapse as many people expected. On the contrary, the market experienced a significant growth cycle as the economy was driven by military spending. The same pattern also appeared in many later conflicts. The Korean War, the Vietnam War, and many regional conflicts in the post-war era all show a similar pattern. The market may be highly volatile in the short term, but it does not necessarily weaken in the long term. Why does this happen? The reason lies in a very basic factor of macroeconomics, government spending. When a war occurs, governments usually expand their budgets on a very large scale. They increase spending on defense, logistics, energy, technology, and a wide range of related industries. In economics, this is almost similar to a massive fiscal stimulus package. If a government decides to increase its defense budget by hundreds of billions of dollars, that money does not disappear. It flows into companies that produce equipment, into supply chains, into the energy sector, into technology, and eventually into the income of millions of workers. When that flow of money spreads through the economy, the business activities of many companies actually expand. This is why many economists say that war, although it brings terrible human consequences, can create a form of short-term economic stimulus. This does not mean war is good, but it explains why financial markets sometimes react very differently from what our intuition predicts. Another factor that prevents markets from collapsing for a long time during war is the nature of the stock market itself. When you buy a stock, you are not buying the present of a company. You are buying the expectation of its profits many years into the future. Large investors understand that even if war creates short-term volatility, the global economy continues to operate. Businesses still produce. Consumption still exists. And technology continues to develop. This leads to an interesting paradox. The moment when the news appears to be the worst is often the moment when the market has already priced in most of the fear. Once the event has occurred and the level of risk begins to be priced more clearly, investment capital often returns. Looking at historical data after 1945, most major military conflicts create a familiar pattern. The market reacts negatively in the first few days because uncertainty increases sharply. After that, when information becomes clearer and governments begin implementing economic measures, the market gradually stabilizes and recovers. This leads us to an important conclusion that many investors often overlook. The market does not collapse because of war. The market collapses when the flow of money in the economy is disrupted. If war leads to a deep recession, a frozen financial system, and collapsing consumer demand, the market will react negatively in the long term. But if war only creates an initial psychological shock while the economic flow of money continues to operate, the market usually finds a way to adapt. And this is exactly the point that professional investors focus on. They do not only look at news headlines. They track government capital flows, monetary policy, and global supply chains, because those factors are what truly determine the long-term direction of the market. Part 2: When a crisis happens. Where will the money flow? After understanding the important truth that the market does not simply react to war, but reacts to capital flow, the next question a real investor needs to ask is not will a crisis happen, but if it happens, where will the money move? In finance, money always moves. According to a very clear logic, it seeks places that can protect value or generate profit in the new environment. And when the world enters a period of major instability, the structure of global capital flow often changes according to patterns that are fairly easy to recognize. The starting point of any investment strategy during a crisis is always liquidity. This is a factor that many individual investors ignore when the market is growing strongly. But it becomes extremely important when instability appears. Liquidity is not meant to generate profit, but to create the ability to react. When you have cash or highly liquid assets, you have the power of choice. You can remain stable when everything becomes chaotic. And more importantly, you have the ability to buy good assets when their prices drop sharply because of market panic. In every major financial crisis, investors who have liquidity are always the ones with the greatest advantage. After that first layer of defense, capital usually begins to move into assets that are considered safe havens of value throughout thousands of years of economic history. Gold has always played a special role during periods of instability, not because gold generates cash flow like stocks or bonds, but because it is seen as an asset that does not directly depend on the financial system of any single country. When confidence in currency, the banking system, or economic stability begins to shake, demand for gold often increases. Interestingly, in recent years, it is not only individual investors who buy gold. Central banks around the world have also been increasing their gold reserves at a significant pace. This reflects a larger trend in a complex geopolitical environment. Countries are also trying to diversify their reserve assets, alongside safe haven assets. Another flow of capital that often increases strongly during crises is the defense industry. When governments perceive rising geopolitical risks, military spending almost always increases accordingly. This is not only a matter of military strategy, but also an economic decision. Defense programs are usually very large and last for many years, which means they create stable revenue for companies in this sector. In many historical periods, the stocks of defense companies have actually become assets with relatively strong performance when the world enters a time of geopolitical tension. Another sector where capital often concentrates is energy, especially oil and natural gas. The reason is quite simple. War and instability often disrupt energy supply chains. When supply becomes uncertain, energy prices tend to fluctuate strongly, and in many cases rise. This makes energy extraction and production companies businesses that may benefit when commodity prices increase. History has repeatedly shown that major geopolitical shocks are often accompanied by strong cycles of rising oil prices, beyond industries directly related to war. There is another group of assets that receives less attention but becomes very important during periods of instability. Companies that provide essential goods. When the economy struggles, consumers may reduce spending on non-essential products, but they still have to buy food, medicine, energy, and basic services. This makes companies in the consumer staples sector often have more stable cash flows during periods of strong economic volatility. For this reason, many large investment funds increase their allocation to these companies when macroeconomic risks rise. Finally, one factor that cannot be ignored during a crisis is inflation. Periods of geopolitical instability are often accompanied by strong increases in government spending and disruptions to supply chains. These two factors can create significant inflationary pressure. When that happens, assets that can protect the purchasing power of money become more important. This may include real assets, such as commodities, energy, or financial instruments designed to protect investors from inflation. Looking at the bigger picture, a portfolio prepared for crisis is not a portfolio that tries to predict exactly what will happen. Instead, it is built on an understanding of how global capital flows react to instability, liquidity to create flexibility, safe haven assets to protect value, industries that benefit from government spending and commodity shocks, and essential businesses with stable cash flow even when the economy becomes volatile. That is exactly how professional investors view crises. They do not try to run away from the market. They try to understand how its structure is changing. And when you begin to look at the market in that way, a crisis is no longer just a threat. In many cases, it becomes the moment when the greatest opportunities begin to appear. Part 3. The biggest lesson in a crisis. The rich do not act out of fear. After everything we have analyzed from investor, panic, psychology, to how markets actually react to war, to the way capital flows shift during crises, there is one major lesson that financial history has repeated hundreds of times. The people who become wealthy during crises are rarely the ones who react the fastest, but the ones who maintain discipline the longest when instability appears. The market usually divides investors into two very clear groups. The first group is those who react emotionally. They see the market fall sharply, read negative news, and begin to believe that the worst is coming. They sell stocks to protect their assets, hold cash, and wait for a safer moment. But the problem is that the market rarely gives you a clear signal that everything has become safe again. When the economy begins to recover, the market has often already risen far from the bottom, and those who sold earlier usually return too late. The second group consists of investors who understand a simple but powerful principle: markets fluctuate in the short term, but grow in the long term. Instead of trying to predict every movement of the market, they focus on building an investment strategy that can survive through many economic cycles. This usually includes holding quality assets, maintaining investment discipline, and continuing to accumulate assets even when the market is declining. One of the simplest but most effective long-term strategies is periodic investing, also known as dollar cost averaging. Instead of trying to find the perfect moment to buy or sell, the investor continues to invest a fixed amount of money over time. When the market declines, that amount of money buys more shares. When the market rises, the value of the portfolio also increases. This method removes a very dangerous element in investing trying to predict the market. Historical data shows the power of this approach. Over many decades, the S&P 500 index has gone through countless crises, wars, recessions, oil crises, the technology bubble, the global financial crisis, and the pandemic. Every event created the feeling that this time everything will be different. But if you look at the long-term trajectory of the market, the overall trend is still growth. This does not happen because the market is immune to crises, but because the economy and technology continue to move forward. Businesses improve their products, expand markets, and create new value. In the long term, that process of innovation is the primary driver of market growth. Another factor that is often underestimated is the impact of inflation on cash. When investors sell all their assets and hold cash for a long time, they may feel safe in the short term. But over time, inflation gradually reduces the purchasing power of that money. This means that avoiding risk sometimes becomes another risk, the silent loss of asset value. For this reason, many successful investors do not see crises as the moment to completely withdraw from the market. They see them as the moment to reassess their portfolios, strengthen investment discipline, and take advantage of opportunities when asset prices decline. This requires something that is not easy to have in investing: the ability to remain calm when most of the market is panicking. If we look back at financial history, we will see a very familiar pattern. When a crisis occurs, asset prices fall because of fear. After that, as uncertainty gradually fades, the market recovers. Those who sell in panic often lose the growth of that recovery phase. Meanwhile, those who maintain their investment strategy become the ones who benefit the most. And that is perhaps the simplest truth, but also the hardest to execute. In investing, success does not come from reacting faster than the market, but from understanding the market deeply enough not to react to its fear. Because in finance, a crisis is not only a test for the economy, it is also a test for the psychology of every investor. And history has shown very clearly those who pass that test are often the ones who build the most sustainable wealth in the long term. If you look back at this entire story, you will notice something very interesting about the financial market. The world's major events, wars, crises, instability often make people afraid. But the market is not driven by fear. It is driven by capital flow, productivity, and time. The investors who lose the most money during crises are usually not those who lack information. They lose money because they react to the emotions of the crowd. Meanwhile, the people who build large wealth often do the opposite. They understand how the system works, maintain discipline when the market is chaotic, and remain patient while others are rushing. Now, I want to ask you a question. If a global crisis truly happens tomorrow, will you be the person who sells assets out of fear? Or the person who understands capital flow and prepares for the opportunity in advance? Leave your thoughts in the comments section below. I would really like to know which side of the market you stand on. And if you are interested in deep financial analysis like this, the kind of insight that most investors only understand after many years of experience, press like and subscribe to the channel, because in the next videos, we will continue to break down how money truly moves within the global economy.